bond king and DoulbeLine Capital founder and CEO Jeffrey Gundlach, who, by the way, has amassed more than $100 billion in assets over just 7 years.
Joining us today is a giant in the world of finance. Jeffrey Gundlach is the CEO of DoulbeLine Capital. His mutual funds hauled in more than $1 billion last month alone. And when he speaks, markets move.
You are known as a math whiz.
I liked math, and so suddenly I turned into a math guy. My father's a chemist. My uncle invented the Xerox copier. He was a physicist. Well, I don't believe in models. I'm a math guy, but what it really means, the way I think about things, is space relations. It's more of an abstract way of thinking of math rather than a bunch of Greek letters and formulas, which is more applied math. And I think one of the reasons that we've been able to succeed at DoulbeLine is we think about fitting portfolio pieces together, kind of like a space relations problem. When we build portfolios, I have a funny phrase for it. I call it loading the dishwasher. You know, if you have a dinner party, you've got tons and tons of dishes, how do you make them all fit in the dishwasher?
Right.
That's kind of the way we think of portfolios. Every asset class, every type of bond has a different risk, different reward, works differently with the economy, and so they sort of have a shape to them. And the idea is to fit them all together so that you don't have any gaps. What's a 2-year bond that essentially yields the same as cash at zero? It's a promise to get a suitcase full of cash in 2 years. I'd rather have a suitcase full of cash today than someone promising to get to me in 2 years. So we don't like the short end of the curve at all. I mean, the Fed is not going to raise interest rates voluntarily to suppress GDP to fight inflation. The Fed probably wants inflation to go up. That's the way out of this debt problem, is to have some nominal GDP. Why in the world would you do a 1980s Volcker type of thing and raise interest rates to suppress nominal GDP, which is what you're doing when you're suppressing inflation? So you don't buy short bonds today.
You actually walked into Trust Company of the West knowing nothing about bonds?
No, I learned about bonds the week before I walked into Trust Company of the West.
Deep experience. What'd you learn from Homer and Leibowitz's classic?
And then the second part of the book was a whole bunch of formulas about how bonds work and all this stuff. And I had been at math graduate school at Yale. And so I went and I derived all the formulas myself to try to understand what was going on.
Sure.
I was so naive. I figured everybody did that stuff, that everyone really derived the math formulas. But it helped a lot to understand. A lot of people like to use predictive models. They like to take the variables that drive, say, prepayments on mortgages, which is a big thing in the mortgage market, and they like to think they can predict what they're going to be, and they put a lot of brain power into trying to guess what they're going to be. We take a different approach. We kind of believe in what Socrates said, and that is, it's not that you try to know everything, it's to respect the fact there's certain things that you cannot know.
Right.
You can't figure it out. So don't delude yourself that you can know everything. So what we do is we say, look, interest rates are either going to go up or down. That sounds non-controversial ultimately. So if interest rates go down, it means that refinancing activity will go up. We don't know how much, so we explore it, and we explore kind of the parameters that are plausible. And the same for rising interest rates. And in that way, we risk protect, because we look at discretely what might happen for discrete forward-looking scenarios, rather than guessing some model what's going to be. Well, I'm not really sure what goes on inside of JP Morgan. I mean, so it's hard to know. But typically, when there's blow-ups, it's because models assume various correlations.
Correct.
They assume that if X happens, then Y will happen, and they delude themselves. They think that you can know that, say, if the Spanish yields drop by 100 basis points, then for certainty something's going to happen, say, to the US junk bond market. And you can get loose correlations that are somewhat convincing, but you have to understand that you can't know exactly what's going to happen. Whenever you have these hedge funds that blow up and everything based on correlation trading, it's because they are over-believing in the precision of models to forecast the future. But the biggest mistake that investors make when they're in a winning trade is they get out too soon. The genius at Apple isn't there anymore.
I found that to help manage bonds, it was important to try to understand the whole picture and put it all together. I think dollar is going to be a strong currency, not a weak one. Deal with it. But we also have $123 trillion in unfunded liabilities. The state and local pension systems in the United States, on average, are 50% underfunded. So if you take a look at Illinois, there's no chance that Illinois can honor its pension obligations to its public unions. It cannot do it. If we funded $123 trillion of future liabilities, that's 6 times GDP. If we did that over a 60-year period, we would have to take 10% of our GDP every year and put them aside into funding these liabilities. So we'd go from an economy which is 6% in deficit, we'd have to go to one that's 10% in surplus. So it would be 16% swing from where we are today. So we cannot fund these liabilities. But when the next recession comes, there's going to be an outrageous opportunity in corporate credit. And I think you want to own none right now, none. I knew what was going to happen in the housing market. It took a little longer than I thought, maybe by about 6 or 8 months. But then what I became known for is I spoke at a very prominent conference in June of 2007. And I went on stage not fully sure what I was going to say. I didn't have any notes or anything. I had some slides. And all of a sudden, seemed like it was the right moment. And I made the declaration, subprime is a total unmitigated disaster, and it's going to get worse. That phrase was captured in the media on 5 continents. And at that time, the subprime sector, the AAAs, the AAs, they were still trading at 100 cents on the dollar. They hadn't dropped at all, 0. And they really started dropping in earnest in the first part of 2008, later part of 2007. When you're looking for distressed opportunities in fixed income, the best ones come from things that are misrated going into the problem. Because the people that buy investment-grade corporate bonds are looking for safety. Right. They think they have safety. When you buy a AAA rated subprime floater, you're a AAA person. You didn't sign up for a lot of risk. You signed up for a little bit of reward, hoping that the risk was de minimis. But then it ends up being a big risk. And so it's not surprising that the people that sign up for safety sell when the market goes down, because their eyes have been opened and they now realize that they were fooled. And that creates another layer of selling. Bitcoin was the crazy thing. Bitcoin going from 0 to 20,000 in a straight line, it was crazy, and you knew it was crazy because other things started to happen that were truly insane. There was a thing called CryptoKitties. Yeah. It wasn't a cryptocurrency. It was a collectible, but it had the word crypto in it, and they were each unique, but there were cartoon drawings of cats. And there was actually a moment where one sold for over $100,000. Of course, they're worth 0 today. But that is a sign. That's like pets.com back in the late 90s. Bitcoin was insane, and it crashed starting in December of 2018. Then the global stock market peaked a month later. Then the transports peaked, the utilities peaked. Then the Dow Jones Industrials peaked. Then the S&P peaked. Then finally the NASDAQ peaked. And then it was down to 5 stocks. And then it was down to 4 stocks. Then it was down to 2, Amazon and Apple. And then on October 3rd, it was over. And so that's how a bear market develops. And I think that it's been saved by the Fed's pivot. And it's been saved by the bond rally, taking some pressure off the stock market. But if the long end of rates starts to rise, as I expect, and if we break through 350 on the 30-year, I think it's over, because the competition from the bond market, particularly against a climate of limiting one of the engines of stock price appreciation, which is buybacks. I look at news wires more than anything else, and I try very hard to pay no attention to what other people think. Watch for those times when the news doesn't change, but the interpretation does. Or the news does change, and the interpretation doesn't. Those are moments where there's this gap of opportunity. And I think my primary skill has always been living in that gap in a way that's quicker than other people. He said, we're going to keep short-term interest rates at 0 for at least 3 years. He pre-announced 3 years of 0 interest rates. And shockingly, many instruments in the bond market that were sure to profit tremendously from 0 interest rates for 3 more years, they didn't go up in price for like half a day. And I bought them all. And it's like, why aren't people buying this? I don't know, but they should be like 20 points higher. And they were 20 points higher about 2 weeks later, but they were actually there to be had because people want to see the idea that they have get ratified or corroborated by a crawler on some financial program. And they, oh, I see, now it's safe to do this because everybody else saying that this is the conclusion you're supposed to draw. But by then it's priced in. So the opportunities, by the time it's safe and you have a confirmation that your idea might be broadly embraced, by then it's too late. is we just look for correlations. The Fed's underlying inflation gauge, which doesn't get nearly enough attention, it correlates incredibly well to CPI, core CPI, on about an 18-month lead basis. It's got about an 80% correlation. Nobody knows about this. Well, we do. Unfortunately, I speak to people like you and I give my ideas away, but it's okay because relationships don't hold up forever. The world changes, the variables change, the coefficients change that drive things. And so it's really important that you sort of just stay on top of it. That's why I do what I do. I mean, I could have retired a long time ago. I find it very interesting as a way of processing human behavior, society, and just understanding what makes the world go round. I tell people when they start working here, at many firms, you succeed by killing the person next to you. If you even go in that direction, you're gone. I want people to want the person next to them to do well, because the person next to you doing well means the firm does well. And so we have a shared success philosophy, and it kind of comes from the top because I never yell at anybody. My philosophy is everything that goes right, the team did it, and everything goes wrong, it's my fault. And I think that people appreciate that. Human interaction, which in this particular instance reveals itself through financial markets movements. And so I just sort of like it. Also, I'm committed to a couple of charitable enterprises that basically need a lot of money.
Right.
So it's a good reason to work so that it can be funneled not just to the Internal Revenue Service and the United States Treasury, which I am a very significant contributor to, but also to something that I think matters rather than just some rat hole of administrative waste. And so I don't really resent the fact I pay so many taxes. It's sort of a privilege in a certain sense, but I also want to be able to see results for the money that I'm giving away.
You can have impact.
You know, and it's a very big impact when it doesn't go through a bureaucratic machine. Rich people like you only pay 15%. I'm telling you, it's 52.6, all right? So that's because California's 13.3, and then there's the federal, and there's other things. So if they raise it to 70%, that'd be a 33% increase. I would go to 85.6%. I really think I would stop working.
Yeah, who would even work at that point?
I really think I would stop working at 85.6. Instead of raising me from 52.6 to 85.6, I think the 14ers should come up to 52.6. There's a double line in the middle of a highway.
Right.
It's really there for your protection. And the reason, of course, is it's not safe. And so I realized, hey, that's pretty neat because I'm really risk averse. I think more about what you shouldn't do than what you should do. And what you shouldn't do is take fatal risks. That's what kills particularly fixed income investors. If you buy a lot of junky bonds and they default, your money's gone forever. If you buy a bunch of mortgages and they refinance at the wrong time, you've kind of lost money forever. And I thought that's perfect because it defines things that we won't take certain fatal risks. There's a lot of misreporting that goes on in financial media. So I like interviews that are live or ones that I do a written statement because I find when I do webcasts, for example, the stuff that gets reported, more than half of it's wrong. I mean, no, I didn't say that. They'll leave out the word not and invert the meaning. So I like to have the Twitter account where if something like that goes off, I can say, you know, this is actually this is truly where I'm coming from.
But we'll never see Jeffrey Gundlach on Facebook?
Never. Things that are safe end up being unsafe. I think that's Facebook. I mean, they sell themselves as comfortable and safe, but they're really just a diabolical data collection monster. 20% is obviously an arbitrary number. It's more of a mentality. Yeah. It's more of a change in preferences and the way people think about things. In 2018, for the calendar year, not the fiscal, which is in September, but for the calendar year, the data was just announced recently, the national debt increased by $1.48 trillion. Now, that's about 7% of GDP. And this is when we're supposedly in a good economy, with 3% real GDP, 5.3 nominal through September. We don't have the data through year end yet. Are we really growing at all in an organic way? Because the most recent data point on GDP, 5.3, is less than 7% of GDP, right? Yeah. Less than the growth in the debt. So if we hadn't grown the debt by 7% of GDP, I guess we'd have a negative economy right now. And so what happens, one has to ask, during the next recession? just how big is the deficit going to be? Foreigners are not buying our debt anymore. The Fed, for now, is not buying our debt. Maybe change their mind again. I mean, again, one of the most amazing reversals, autopilot QT, to last week, an admission that they're discussing using QE as a regular tool, not just emergency, even when you're not at zero interest rates. You don't just use it as part of your ordinary toolkit. So what happens when the next recession comes? Will the deficit be 4 trillion, 3 trillion? I don't know, but usually our deficit to GDP ratio goes up by 4% from the good times to the recession. Does that mean we're going to go to 11%? Maybe worse than that. Well, there's items that are off budget.
The problem is the Fed shouldn't have kept them so low for so long. Sure. The problem is that we shouldn't have had negative interest rates like we still have in Europe. We shouldn't have done quantitative easing, which is a circular financing scheme. But the problem really is the deficit. The Fed is kind of helpless here. The fact that the deficit is so out of control this late in the economic cycle, we have never before had the Fed raise interest rates while the budget deficit was expanding. It's never happened because usually the budget deficit expands in response to a recession. It's a way of stimulating to get us out of recession. But instead, we did it as a last gasp of keeping this economic recovery going by making it completely deficit-based. A thing called a death cross. It's the 50-day moving average goes below the 200-day, and particularly when they're both declining, it's death cross. Presently, about 80% of the countries in the MSCI World Index are in a death cross. 80%. It's amazing. What a joke. The Fed doesn't have any supernatural powers. They know what we know. They don't know any more than we know. I know they have 700 PhD economists, which is an amazing number, but they didn't see the lending problems back in 2006, so they didn't have supernatural powers back then. I doubt they have them now. I think if the Fed doesn't hike, it'll be because the stock market is weaker, and also the global economy is slowing down. The one thing that's still really good are the leading economic indicators in the United States, the PMI surveys, the sentiment surveys. They're all still really strong and not suggestive of recession, but that's somewhat concerning when the yield curve flattens out. And also, consumer expectations are really bad right now. If you consumer confidence, their awareness of where things are today is still very strong, but if you compare their expectations for the future, it's amazingly weak. I think it's a debt-based economy, so it depends what... When retail sales go up because people borrowed more money, is that really good? I mean, if you meet an old buddy of yours from college and you say, how you doing? And the guy says, I'm doing great. I've got a huge mortgage. I've got a second on top of that. I've got 4 credit cards all maxed out. And I got this brand new watch. I am killing it. And you go, he says, how are you doing? You go, gee, I don't know. I mean, I paid off my mortgage. I don't have any credit cards. I got $1 million saved. Which one of you is doing well? I mean, the one that's consuming a lot might feel good in the moment, like our consumers feel good in the moment, based on the current confidence surveys, but their expectations of the future are weak. Well, that sounds like the guy that's your buddy in college. It doesn't sound like you that has actually saved and are in a position to invest in the future. So I don't really think the economy is all that great. When the deficit expands by hundreds of billions of dollars and you get a couple percentage of GDP, that's just debt. All you did was borrow money, and of course it leads to short-term economic growth. But how are we going to keep this going when we have 1.6 trillion? 8% of GDP nearly is what we're growing our deficit at. You've noticed there was a kerfuffle in Europe about Italy was going to run a 2.4% budget deficit, and all the mandarins were berating them for being, irresponsible. Well, France is at 3.4. Look at these elitists in France at 3.4 budget deficit, berating Italy for being at 2.4, but the U.S. is at 6+ if you look at the real numbers. It's a very large budget deficit that we're running, and that's what's driving our economy. And the corporate economy is also leveraged up at record levels that previously have been harbingers of recession. You can't blame the CFOs at America's companies. They were given incredibly low interest rates by the extreme stimulus policies and That caused a yield starvation that collapsed spreads. Corporate yields were by far the lowest in history. And of course they leveraged up and borrowed money to buy back stocks and leverage up the corporate economy further. So we have a very high vulnerability to higher interest rates. A year ago, and I said if yields go up to 3%, stocks are going to take gas. That doesn't seem like a very high interest rate, does it? But it is when you have zero knit into the marrow of your economic bones, which is what we basically did by leaving rates so low for so long. The dollar correlates very well with the size of the twin deficits. In other words, when the deficits are going much bigger, in broad strokes, the dollar goes down. I don't believe that hope is a method in investing. I think you see identifiable risks and you need to take them seriously. That tariffs don't really hurt the U.S. manufacturing and U.S. output as much as they hurt other countries, because we have about the most disengaged global economy of any developed country in the world. Only 8% of our GDP is exports. So it doesn't really hurt our output that much, but it hurts our consumers. We're getting a free ride by getting lots of cheap goods into this country. If we raise the prices through tariffs, that's bad for our consumers. It's bad for the standard of living of the United States. It might not be, it's bad for the global economy. It might even be worse for non-U.S. countries than it is for us. But it's particularly bad for our inflation rate, for example. I mean, if you raise the price of shoes, that's called inflation. If you raise the price of T-shirts, none of which are really made in the United States, that's inflation. We started about 5 years ago a rules-based equity fund that was based on Dr. Shiller's work, the DoulbeLine Enhanced CAPE Fund. That fund picks equity sectors of the S&P 500 using the CAPE ratio evaluation methodology, and then we run a collateral pool in fixed income, and we have two ways of getting return. One is Shiller's rules work, and also we have, if we outperform LIBOR, which we've been able to do, then we get alpha, and that's been the best performing value equity fund in America over the last 5 years. I still think that yields are headed higher in the United States, and I think it's mostly supply-based and lack of demand. As unsexy as this sounds, a short-term, high-quality bond portfolio is probably the best way to go as you head into 2019. I think passive investing is a mania, or reached mania status as we went into the peak of the global stock market and the U.S. stock market. Exacerbate the problems in the market because it's hurting behavior. So I wouldn't advise anyone to be a passive investor. Capital preservation means high quality, lower volatility, lower duration bond funds. Also, I think that capital preservation probably means investing somewhat in small percentage in commodity strategies, which I think will hold up reasonably well with a weaker dollar. The worst thing you can do is what everybody has done: crowd into S&P 500 index funds, because that's the most expensive market. The reason it was the last man standing had something to do with the popularity of passive investing and herding mentality, and what leads you to the upside leads you to the downside. So my strongest advice is to not invest in passive U.S. equity funds, where two diametrically opposed ideas are extraordinarily simultaneously warmly embraced: passive in equity, and not just active in bonds, but uber active, right? Do anything, not even a benchmark, not any type of guideline constraints. In the 90s, people loved passive bonds and they loved active equities. And now, 25 years later, it's exactly flipped. And as night follows day, mark my words, it'll flip back again. And if you use leverage ratios alone, that 45% of the investment grade bond market would be rated junk right now. The government tells you that the deficit was a little under $800 billion, but they're not really telling you the truth, because the national debt is the debt. Government funding another branch of the government that you can't finance yourself. Maybe long-term interest rates won't fall. Leading economic indicators, that year over year always has gone negative before the front end of a recession. And while it's weakening from a very high level, it's still pretty high at around 5% year over year. What is signaling recession a little bit more are sentiment surveys. The PMI surveys typically collapse
in a very observable way before the front end of a recession comes. They are collapsing sort of right now, but they're still at high levels. Consumer sentiment, same sort of a thing. What would really be a major indicator would be if the unemployment rate would go above its 36-month moving average, which right now rests at 4.3%. Unemployment rate right now is at 4.0, so it's not terribly far away from that moving average. But we have to watch that very carefully, because if that cracks above, then I think we would say that we're starting to flash yellow for recession. Another indicator that's very important are junk bond spreads. Junk bond spreads before the last two recessions really blew out by several hundred basis points before the front end of the recession came. The foreseeable horizon is typically no longer than 6 months, usually more like 4 to 6 months. And there is no yield curve at all from basically LIBOR out to the 5-year Treasury. You're all at about 2.5%. That suggests that the market is looking for no movement from the Fed, frankly, for years to come. I'm sure that won't be the case, but that's the message from the mathematics of the yield curve right now. But the politicians clearly are talking about socialism. Democratic socialism just puts the word democratic in front of the word socialism because it sounds good, that at least you're voting for it instead of being forced into it. But socialism is not a very good way of building wealth, as shown by hundreds of years of history. Most recently down in Venezuela is all you have to look at. It's all part of the cycle that we're in, where the technology has gotten way ahead of the society's ability to adapt to it. But the national debt just went over $22 trillion yesterday, and it's growing at over $1 trillion a year during a growing economy. And our taxation versus GDP has gone from around 20% a few years ago to about 15%. So 15 it's not the lowest level ever, it's just the lowest level since 1949. The growth of nominal GDP was about 5.3%, but the growth of the national debt was 6% of GDP. And part of economic growth is the delta in government spending. So with the national debt growing by 6% of GDP and nominal GDP going up by 5.3%, it means if you had a balanced budget, the economy would have been negative during fiscal 2018. So everything that we're doing is based upon debt expansion. She looked right into the camera and lied to the American people that it is not true that we can't afford Medicaid for all and free college tuition. Going into the 1930s, the tax rate for the average American household was 1.5%. By the 1944, it was 25%. So this is a massive tax increase. Taxation during World War II went from 5% of GDP to 20% of GDP. So no, we cannot afford these things without having a complete collapse of our standard of living as we know it. We all need to have an awareness of the problem before we get the intestinal fortitude to make changes. And unfortunately, our political system is one that does things in response to crisis. And so we're going to have a crisis of the fiscal situation before we finally make the changes that need to happen to the level of spending versus the level of taxation. In the next 5 years, there are $7 trillion of Treasury bonds maturing over that period, and they're paying an average coupon of about 2%. So when that gets rolled over, what if rates are at 4%? That means you're going to have another $140 billion of excess debt servicing costs per year. So this compounding curve of debt, I think, is going to gain a lot more attention. We have a major bear market underway in home builders, and there's no surprise there. I mean, we've had big increases in home prices, far in excess of average hourly earnings growth and income growth over the past 7-8 years or so. And we have interest rates that are up by 200 basis points on mortgages. And when I hear people on financial media say it doesn't matter because rates are still low, that's nonsense. It's the delta that matters. When you've had 3% and lower 30-year mortgage rates for several years in a row, obviously the pricing structure of the housing market has that factored into its construct. And now we have mortgage rates at 5.1%, possibly going to 5.5%. That would be almost a doubling of mortgage rates. And also the University of Michigan survey that says, is this a good time to buy a house? Okay. Also, autos are in a bear market. And banks are doing terribly because the loan volume is likely to shrink as we see interest rates going higher because it's difficult for people to afford higher rates from this level. We've increased the deficit by about 1.5% of GDP. So it shouldn't be that surprising that GDP is up by about 1.5% because part of the equation for GDP includes the delta in government spending, in this case, government borrowing. Last time I checked, and I'm a math major, so I might have some credibility here, last time I checked, 211 is higher than 190. The growth in national debt exactly matches the S&P 500's performance back to 2009. It's really interesting. Balance sheets of the central banks increase exactly the same, if you look at the chart, as the growth in the global stock market, and now those balance sheets in accumulation are going down. So it's not surprising that the global stock market is going down, and away from the US, this is not a good year for stocks at all.
Because typically, when the markets go south, emerging markets get hammered. They're terrible performers. When the strongest correlations in financial markets is when the dollar goes up, emerging markets underperform. And when the dollar goes down, emerging markets outperform. Generally speaking, it's a very tight connection. The dollar moves in very long cycles, 6 to 8 years, and the dollar peaked January of 2017. So it's very likely, based upon cycle work, that the dollar is in for some sort of a longer term underperformance. The best way of thinking about the dollar is what are the expectations for the Fed? Not in the next 6 months. This is the mistake that so many people in financial media make. They say, oh, well, the dollar's got to be strong because the Fed's tightening and the ECB and Japan aren't, so obviously the dollar's to go up. What's obvious is obviously priced in. So the fact that the Fed was more likely to raise rates in present moments is already known. And we've done a lot of work at DoulbeLine. What really matters is not what the Fed's going to do relativistically in the next 6 months. It's more like 12 months to 24 months. The correlation is very high. If the Fed is perceived to be too optimistic in their ability to raise rates, and the bond market says so, then usually the dollar will get weaker in the future. And the stock market dropped, and Jay Powell had the meeting in December, and he did fine until he did the press conference. And he totally bombed at the press conference. It was a complete disaster. We're on autopilot, we're just going to keep doing it. And the market dropped like 800 points in half an hour because they don't like the idea that he's so rigid. Jay Powell was supposed to be a breath of fresh air. He was supposed to be not so academic, not so model-driven. He was supposed to be pragmatic. He was pragmatic Powell. Also, the dollar is extremely sensitive to growing budget and trade deficits. When the deficits grow, there's a very strong likelihood, based on historical patterns, that the dollar will go down. Deficits are growing like a weed, and they're growing like a weed at a time when exactly the opposite is traditionally supposed to happen. Deficits grow as the government stimulates to get us out of a bad economy. Deficits are supposed to shrink like a rainy day fund being accumulated when the economy is strong, that you save it so that when something bad happens, you have a rainy day fund that you can run a deficit and you can end up being counter-cyclical in your fiscal policy. Median household income in America is $65,000. So this growth in national debt on an annual basis is like every household in America taking out 3 $5,000 limit credit cards and maxing them all out. It's not good. I think the moment will come when investors say, you know, maybe if there's a recession, interest rates won't go down. Maybe they'll go down on a Pavlovian response, which they did in December, down to a level that I think is too low. But maybe then people will wake up and go, hey, we're looking at like drowning in treasury bonds. We could be looking at trillions and trillions of dollars of treasury bonds. We're already doing $2 trillion in a good economy. And let's say that there's $700 billion of corporate bonds. That's 2.7. And let's say that there's $600 billion of QE. Do you really want to own a 2.75 yielding 10-year treasury when you can buy a 2-year treasury at 2.6? It just seems like a really bad idea. So I think the yield curve will steepen out. There is a huge underfunding in state and local pension systems across America. Every single state pension system is underfunded, and the average underfunding of state and local pension plans is 50%. Debtclock.org on the internet. It's a fascinating set of panels, and it's dizzying because it spins like a Tokyo taximeter. And what they show is if you tally up all of the unfunded liabilities, state, federal, local, Medicaid, Medicare, Obamacare, Social Security, the United States total unfunded liabilities presently, and they're growing every second, is $122 trillion. Our gross domestic product is $20.7 trillion. So we have 6 years of GDP. Corporate credit has exploded in recent years. This is the corporate credit as a percentage of US GDP. It's an all-time high. These are the maturities I talked about. See how there were none in 2018 to speak of, and it's how they go up. Junk bonds, not so bad, but there are more junk bonds than the world thinks. So bond ratings are AAA, AA, single A, triple B, all of the above are investment grade. Each one is sequentially viewed to be a weaker credit. Once you get to double B, it's now called speculative by old school parlance. That means that a prudent person might not want it. Is that of all the investment grade bonds, AAA, AA, single A, and triple B, they say 30% should be rated double B. And 15% should actually be rated B, which means 45% of the investment grade bond market should be rated junk per this Morgan Stanley study. Well, I've got some secret news for you. When bonds get downgraded, their prices go down. What would happen is you would have an en masse panic. I think that the corporate bond market today, the junk bond market, is in a similar position to what the mortgage securities market was in 2007. It was misrated, and I remember when the bonds went down that had never gone below 100, they went down to 80. And people were cheering what a great buying opportunity it was. And it was for a while. They went back up to 94. But then they started dropping again. And what ends up happening when people do the buy the dip thing, and it's not really the bottom, is you have the first wave of selling that creates the dip, you have the relief rally, and then when the bottom gets taken out from the dip buying, the people that bought the dip turn from buyers into scared sellers. So I remember when the mortgage bonds went from 100 to 80, people loved it. They thought it was a great idea. They bought them. They went up to 94. They ended life at 20 on the bottom. 20. So I think that there's massive risk in the junk bond market and the triple B market, which is really the junk bond market that's unknown to be a junk bond market per the rating agencies. You know, that's what the Fed likes to say. That works great in practice, but what's the theory on the things that they do? If you average the nominal GDP of the United States with the yield on the German 10-year, you have an uncanny guidepost for the 10-year Treasury yield. Let's do the exercise right now. Nominal GDP in the United States is 5.5, but that's for the third quarter. We have a pretty good view of the fourth quarter because it's in the books except for some of the data from December. And we believe that it's sensible to expect a 5.2 nominal GDP. We have a GDP estimate from the Atlanta Fed, which is so far along that's probably likely to be nearly right, of around 2.8 or something like that. And if we just assume that the inflation rate from the third quarter carries over, we will have 5.2 nominal GDP. The German 10-year closed last night at 27 basis points. So that takes you to 5.47 is the sum of those two. Dividing by 2 to create the average, you get 2.735. The 10-year Treasury today closed at 2.733. And it's been tracking with minimal error for years. It's not something that we data mine and just happened to work. It's been working out of sample for a long time. I've started to wonder why I bothered to even think anymore.
Why does it work?
Well, the old school idea was, and this was supported by a lot of traditional economists, was that nominal GDP should be the guidepost for the 10-year Treasury. So there's basically two ways for the 10-year to break out of this range. One is the German 10-year could push to the upside. It seems very unlikely to me that it's going to push to the downside, given that there's a negative real rate there. So there's potential upward pressure on the 10-year. And then U.S. nominal GDP, could fluctuate. We're not really sure what that's going to be in the quarters ahead. The ratio of the price of copper to the price of gold. Directionally, it's highly predictive of at least the direction of the 10-year Treasury. For example, when the 10-year Treasury was moving up above 3% earlier this year, the copper-gold ratio was heading south. Copper was falling, and gold was finally beginning to rally. And so that ratio was going down.
And it suggested that we would have a move down in interest rates, and certainly, indeed, that was the case. It further from this point does suggest further drops in interest rates, but maybe copper goes up. I don't know, and there are leads and lags on that one. The European Union will never work. These rules imposed by these mandarins in Brussels and Frankfurt, imposed destroying the economies down south. It doesn't. The whole thing is a cockamamie scheme. I'm surprised it's lasted this long. What investors need to understand is that there is a connection between Bitcoin and the basic social mood of what was speculation and is now a little bit more, cautious. Is Bitcoin very clearly leads risk assets, and let's just talk about the S&P 500. Bitcoin started tanking in the middle of December, and the S&P 500 started tanking after January 26th. And people don't understand that Bitcoin is the poster child of the social mood and the speculative kind of animal spirits. When you hear the word never, we all know it means it's about to happen. The stock market can't take higher bond yields. And the line in the sand that we talked about in the past was 263 on the 10-year. And I said that if we break above 263, it's going to be trouble for stocks. And boy, was that right. I mean, the second we went above 263 is when stocks started to get wobbly. And real GDP leads CPI with a correlation of 0.79, which is very high. And it leads it by about 18 months. And real GDP started to go up 18 months ago. So we should expect CPI to be moving higher. Another gauge is the New York Fed's underlying inflation gauge, the UIG. That also has a correlation with a lead of about 16 months of 0.8, which is, again, very high. That started rising about 16 months ago. You can look at PMIs that have a leading aspect to them. They suggest inflation should rise, not by a huge amount, and maybe only temporarily, who knows? But it shows that inflation should go up, which means with CPI likely to print on the DoulbeLine model at 2.6 for the July month year-over-year number, it's really hard to see why the 10-year yield should drop below 263. And that's really problematic. Now, yeah, the Dow theory is by Charles Dow, the Dow Jones Industrial Average. And basically the theory is that the transports, which used to be called the rails back in the day of the railroads, the rails, the transports, and the Dow Jones Industrials, if they get in sync on the upside or the downside, the Dow theory says it's very important. So there's been a Dow theory buy signal for a long, long time. There hasn't been a bearish indicator from the Dow theory in forever. What you really need is for both the Dow Jones Industrials and the transports to together take out the recent low. And that almost happened on Monday. It was going to happen, but the late rally on Monday stopped it. And the transports did not take out their low, whereas the Dow Jones Industrials long ago took out its low. Historically, when you go into late economic cycle, and particularly when you start getting closer to a recession, what a lot of people don't understand is commodities actually go up a lot every time, going back to 1972. That when rates are very, very low, will the curve really invert at all? Because I can see why if the 10-year yields 8 and the 2-year yields 8.50, I can see why people would still buy the 10-year. You're getting 8, which satisfies a lot of investment needs. But when the 10-year is 275, which it was, and the 2 years down at 225, I don't really think it's that exciting to pick up 50 basis points to take that amount of rate risk. So maybe the curve won't invert this time. And I'm reminded of the old adage that you need buying to move prices up, but prices can fall of their own weight. And I think it has something to do with all this bond supply and these deficits that I've been talking about now for about 18 months. It's now here in real time. I mean, we're borrowing like $100 billion a month. And don't forget, they're doing it at the same time that we're ramping up quantitative tightening. So we have this double-barreled Fed thing. We will raise rates unless the data gets worse. The 2-10 spread that we talked about a moment ago, that certainly isn't giving a warm and fuzzy feeling about what the Fed is doing.
By Zuckerberg?
Yeah, I thought that he was very semantic in the way he was answering questions as opposed to fulsome. And one of the charts I used on stage today, once the regulators show up, they tend to cause problems. There's basically 2 modes of regulation by Congress: none and overreaching. When they started to talk about regulating biotech companies, for example, the stocks just started tanking. And Facebook dropped. The day after the San Francisco earthquake, the legendary investor Jesse Livermore shorted the market because he couldn't believe that the market was actually unchanged. And he said, this is a big event and it hasn't been digested into the bullish psychology of the market. I think there's going to be a lot of turbulence in the air for this flight.
Bitcoin peaked about a week after I said short it. If you take the capitalization of the S&P 500 and divide it by the holdings of central banks, the ECB, the Bank of Japan, and the Fed, it's almost a constant. You can make the argument that the stock market has been propelled pretty nicely, and the global stock market too, by quantitative easing. There is a theme that you hear financial media report that the yield curve is somehow very flat and signaling recession. It's flatter than it was before, but it's actually at the 40-year average.
Be a good opportunity to buy as opposed to be panicking out of your positions.
Absolutely. The best trades that I've done over my 30-plus year career have always been the ones where your hand's almost shaking out of fear when you're writing the ticket. It's called low volatility equity funds. There's no such thing. There's no such thing as low volatility equity funds. It's an oxymoron. Utilities have been great over the last 3 years, have been great year to date, but they're not low volatility. They look like they've been. But during the 00s, there was a drawdown in utilities during that decade of 57%, peak to trough. I always get concerned when investors are buying something that they think is safe, that underneath it really isn't safe at all. And that's when you really get problems in markets. Remember subprime back 10 years ago, there were AAA rated securities that were floating rate. It looks like there's no risk. There's no interest rate risk because they float. They're AAA rated. There doesn't seem to be any credit risk. They dropped 80% in value. Frankly, I think in our world today, you're better off buying things that are perceived to be risky because at least they're priced like they're risky. The mortgage REIT index and REM has been negative in return since 3 years ago. Utilities are up about 40%. I want the one that's negative over the last 3 years, not the one that's up 40%. And by the way, the yield of REM is 11 and change. The yield of the utility index is 3.03. They predict what they want to happen, they want to happen rather than what's going to happen.
Exactly.
And people are asking me, what should policymakers do? What should people do? And I say, that's not my job. I'm not a policymaker. I'm not a central banker. I deal with realities.
The junk bond market simply didn't exist when interest rates were rising in the 1970s. We're all what I call summer insects. I'm quoting Zhuangzi, the Taoist philosopher that followed on after Lao Tzu, who wrote the Tao Te Ching. He said, you can't discuss ice with a summer insect. Well, the junk bond market, we think, all of us that study it, we think the average default rate is 4% with a lot of volatility. But what if that's only because you're able to roll over at lower interest rates? What if you're rolling over at moderately higher interest rates? What if the 10-year does go to 6 between now and 2020? What are junk bonds going to yield? It ain't 8. It ain't 10. I bet it's more like 15.
So what's the real inflation rate? Well, I suppose it depends on what you're personally buying. But I don't like real GDP for that reason. And also, we don't live in an inflation-adjusted world. We live in the real world, where you need to pay your debts with real money, not inflation-adjusted money. And the economy has to grow enough in nominal terms to pay off those debts with nominal money. Nominal GDP, year over year, is now 3.7%, which is lower than it was in September of 2012, when the economy was deemed to need emergency stimulus. Most people call me contrarian, which I really rail against. I'm not really contrarian at all. I just think independently, and I don't start with a preconceived notion. Instead, I go where the data takes me. Risk management is about identifying potential problems and then altering portfolio holdings so that hopefully those problems don't affect the investments as negatively as they might other ways of investing the money. So some people say, I find, 20 risks for every 3 that actually exist, and I say that's fine because I think that that's what risk management is about. A job of an investment manager should be to try to figure out what might go wrong rather than hope for the best, because hope in investing is not a method. The Atlanta Fed here has something they call GDP Now, which takes the daily economic data as it comes out and they put it into some sort of a program and they spit out what their work says the GDP is about to be for the current quarter. So the Atlanta Fed has been much better with this model than most economists have been. That's the number that I think is the most important economic number in aggregate for the United States economy, nominal GDP. But then we have employment cost index was up at 3%. We've got the personal consumption expenditure. There's so many inflation indices and they all tell a different story. So what's the real inflation rate? Well, I suppose it depends on what you're personally buying. When I started in this business, everyone was scared of inflation. Now everybody's starting to want it.
and everyone's afraid of deflation. The pendulum swings. Just like 20 years ago, everybody wanted bond passive management. Index funds got the job done. They were returning 8%. They had good yields on them. Now nobody wants, I don't want a bond index fund that has high interest rate risk and a yield of 1 3/4. I don't want that. But weirdly, today everybody wants passive equity funds. We live in a world where two ideas sit next to each other that are completely contradictory. Active management is the only way to go, and passive management is the only way to go. And I think those are pendulums that swing back and forth. You need nominal growth, because if your debt is compounding faster than your economy is, you've got a problem in terms of debt service. And so this is why people are hoping that inflation will actually go higher, in stark contradiction to what it used to be in the 1980s. I call Gundlach's law of investment risk. And that is that the frequency of problems times the severity of problems equal a constant. So the more you try to manipulate something into no volatility or constant growth, once it gets away from you, once you let go of the tiger's tail, the problem is much bigger than it would be under normal conditions. It's kind of like those hedge funds that try to do 75 basis points per month every single month, and they do it for 3 or 4 years, and then you get the -2 letter, and you find out that they were marking to model and it was really -20, and 6 weeks later you get the bankruptcy notice. So I think China is due for a major setback. There's one thing you've got to learn to be successful in fixed income. You've got to know what your true duration is. Forget what some yield book system says or some third-party vendor system says. That's just a mathematical thing. You've got to understand, if treasury rates move by X, what's my best guess, based largely on experience and thinking, of what will the price of this bond do? The reason so many people lost money in 2011 and lost tons of money in 2008 is they thought by owning long duration subprime, long lived subprime, long maturity corporate bonds, long maturity emerging markets, they were long. Right. Well, they had a duration of -20 because they didn't understand that treasury rates going down by X meant these bonds were going down by 2X.
Right, because the environment that would lead to that.
You have to think about what is it that could plausibly drive the decline in rate. Again, I'll go back to energy bonds. Energy bonds have negative duration. There's a company called Paragon where their senior security is trading at 30 cents. It was at par 18 months ago. Rates are down. It has a negative duration. And understanding that is difficult for people to take the CFA. The CFA books don't talk about this. They talk about other things. And the reason, and it's not their fault, you can't be an academic and learn these things. You'll learn it by experiencing it, probably making a mistake or two or 200 with it, and then finally trying to remember. Investing has a lot to do with memory. You know, my uncle invented the Xerox copy machine. He was asked, what makes a successful inventor? And he said, a successful inventor is an accident-prone scientist who pays attention. A successful investor is somebody that will make all the mistakes everybody else makes, but learns from them. And so you need to have an institutional memory. That's why turnover of personnel is a negative for any organization. Remember, what saved me, frankly, during the credit crisis was memory. I got burned hard on some long-duration mortgages in 1994.
Right.
You know, the old adage used to be stay fully invested and for the long haul and all that. That works during a long-term super cycle, but that's not where we are. We're in a transition period. You're still dealing with an income-starved world, and one where, with your first question, people are trying to find some rate of return. I think dividend-paying stocks are okay if you're in the safe, recession-proof industries. I like put-call strategies. I like pair trades. For example, I liked long the Spanish stock market in May and short the S&P. Okay. The idea being that directionally they're likely to move in tandem, but if you have a really bad outcome in Europe, Spain would drop, but the S&P is going to fall a lot. It's an all-time high, basically. And the idea was if you had a relief rally due to rhetoric and the stimulus types of responses from central planners, then markets would go up. Well, the S&P did go up. Spanish stock market went up much more because it's kind of depressed. has bad things factored in.
Can we trust the numbers coming out of China?
Of course not, but you can trust the price of the Shanghai.
Yeah.
The Shanghai is the one, then there's other indices too. I like the Shanghai because it's full of real estate and finance, all the things that are really suspect. And the price is the price of the Shanghai. That you can't fool around with. The government can manipulate it. Nervous about investing in markets that are manipulated, you better not be in the U.S. market because it's about as manipulated as you can get right now.
Yeah.
Bitcoin is the .com of our world today. And if you use leverage ratios alone, that 45% of the investment grade bond market would be rated junk right now.
You shouldn't have been talking shit.